All right. Hey, everybody. So today we're talking about demystifying the capital stack. Capital stack is one of those terms that you hear in real estate investing and wonder, well, what is it? And understanding the capital stack is key to kind of understanding how commercial real estate deals come together and how they get funded. So feel free to drop any questions that you have in the chat. So first of all, what is the capital stack? So let's imagine that you're buying a building, a $10 million building, and the total project cost is $10 million. Well, let's say you're a random wealthy person that says, I want to buy that apartment building. Most people don't want to take $10 million of their own cash and buy a property with it. So what the capital stack is really just a breakdown of the different sources of capital that come together so that you don't have to pay $10 million in cash to buy an apartment building. And that's one of the special things about real estate is that we can actually put together a capital stack that is quite favorable to the investors. So a typical breakdown would look something like this. And we're going to go into each of these layers of what the 65% might be. And this is just an example. So these numbers might be a little bit different in every deal. And that's something you want to look at when you're doing your due diligence. So the easiest way to understand how this might come together is we'll first talk about the senior debt. So senior debt is this top portion. It's usually the largest portion in the capital stack. And it's as if you were buying a house. Most people, when they first buy a house, they just have senior debt. They just have their mortgage provider. And then you as the home buyer would put down, it's more like 25% when you're buying a home or potentially less. But senior debt, some of the characteristics of it are that they're in first position. With commercial lending, it's usually between 50 to 75% of the total value. So in this case, the value is $10 million. And in this case, we're assuming that the senior debt is going to be a 65% LTV or $6.5 million of the capital stack. So what does first position mean? It means that if something goes wrong with the property, if values drop, for example, office buildings, valuations were all over the place this last year. I know about, for example, I knew an office building whose value during the pandemic shot up to $24 million. And then that was in April of 2022. And then in August 2022, the appraised value went down to $17 million, which pretty much just killed the deal. So what happened in that case? Well, basically the senior debt got paid off and pretty much everybody else lost their money. That was an office building. And that's one of the reasons why I've never invested in offices, because it is it's relatively sensitive to the economic conditions, and I prefer to invest in recession resilient real estate. So I don't say that to scare you, but just to explain about what first position means. It means that the senior debt is really the most protected. The next is junior debt. So junior debt is also sometimes called mezzanine financing or mezz debt. And junior debt is in second position. It's subordinate only to the senior loan, and it would get a higher interest rate. And that's because it's taking a little bit more risk than the senior debt position. So in this case, let's say that the junior debt is 10% of the total capital stack. So that is equal to $1 million. So $6.5 million came from the senior debt. And then we've got $1 million that came from the junior debt. So that's a total of $7.5 million. Now we still need to top off the capital stack with figure out what's going to be in it for that remaining 25%. And so this is where equity usually comes in. So there are two types of equity. Let's go over the first one, preferred equity. So preferred equity is subordinate to senior debt and mezzanine debt. However, it's senior to common equity. So that means that if something went wrong with the property, first, this should say $10 million, should say 65%. So first, the senior debt would get paid down, and then the junior debt would get paid down, and then the preferred equity is next in line. So if the valuation just went down, like let's say it went from 24 million to 20 million, then it's possible that you would still get your money back if you were in the preferred equity space. Preferred equity also sometimes participates in upside. So in this case, we've got 10% of the preferred of the capital stack as preferred equity, so another $1 million. That leaves another 15% or $1.5 million left. Okay, and then the last type of equity is common equity. So common equity is lowest in the priority from the priority standpoint, meaning that they get paid back last. They also have the most to gain in terms of possible returns. So common equity is usually comprised of general partner equity or GP equity and limited partner equity or LP equity. And general partners are the folks who it's the team that's responsible for putting the deal together and for operating the deal on a day-to-day basis, for executing the business plan, and for selling the asset at an opportune time. So they're really the ones who are shepherding the deal, doing everything related to caring for the deal, improving the property, optimizing the property, and then selling the property. Limited partners, on the other hand, are providing cash for the deal, but don't have other responsibilities besides funding, really. So limited partners put funds in, but then they get to sit back and relax and let the general partners do the heavy lifting. So typically common equity, when you think about the cash, that's the dollars that are put in, the general partner will usually fund 1 to 10% of that, and then the limited partners will fund 9 to 99%. I usually like to see general partners put in about 10% of the common equity. That's a data point that I like to, a due diligence point that I like to look at. And the common equity folks have the most to gain in upside. And we're going to talk about what that looks like in a moment. So risk. So this is where it's really important to understand where you fit in the capital stack so you can accurately assess, well, what is my risk in this transaction? And, my job, just as an aside, is to make sure that we are mitigating risks. And so that at every level of the capital stack, people can feel comfortable. Still, it's really important to understand risk to feel confident in investing in these types of deals. So as we said, the senior debt's going to get paid first, and then the junior debt, then the preferred equity, and then the common equity if something were to go wrong. So in exchange for that, we said the common equity has the most to gain. So typically, let's just say these days you might get a senior loan for 6% interest, just as a ballpark. Mezzanine debt might be at 8%. Preferred equity might be at 10. Well, it's probably more like 10%. And common equity would be projected 16 to 20%. So there's a trade-off, right? The senior debt gets paid back first. They're the most protected, but they get a smaller return. And then an additional point that I want to make is with common equity. So common equity usually also has a preferred element to it. So usually there should be a preferred return or a hurdle that has to be met before the general partners get paid any of the distributable cash flow. So what I mean by that is there might be a preferred return of 7%. That's usually what we're seeing these days, 7 or 8%. And what that means is on a cumulative basis, the limited partners will need to receive an 8% annualized return before any distributable cash flow is distributed to the general partnership team. And that creates alignment of interest so that the general partners are motivated to make sure the limited partners get paid before they're getting any of their upside. And I like to look for alignment of interest whenever I'm investing in any type of deal like this, because it's super important to making sure that we're going to have a win-win-win situation amongst all the people that are coming to the table. So here's an example of what a preferred equity investment might be versus the common equity. And the reason I'm talking about preferred equity versus common equity is because we sometimes are able to offer both preferred equity and common equity. So with preferred equity, this most recent deal that we had this offering was our Cheslin Place offering. And what you get in that deal with preferred equity is you get a 10% return every year until we sell the deal. And then you get your capital back. So you get $10,000 in year 1, $10,000 in year 2, year 3, year 4, year 5. And then in year 5, you also get your capital back. So that equates to a 10% return on an annualized basis. This preferred equity is also paid, usually, and sponsors will try to pay that regularly. So you're not getting a variable cash flow stream, you're getting a consistent stream of cash flow. Common equity, on the other hand, will have variable cash flow. So in this case, we've got 4% in year 1, 6% in year 2, 12% in year 3, and then 10% in years 4 and 5. And these are projections, of course. And then in year 5, there will be a $100K return of capital and a projected $58,000 in upside. And so that equals a 20% average annual return projected. So what are the difference between preferred equity and common equity? Let's say you're comfortable with the deal and you feel that the common equity is protected and the preferred equity is protected, why would you choose one versus the other? So usually people are going to choose preferred equity if what they want is cash flow. A lot of investors invest for cash flow because they want to live off of an income stream from their investments, and they're not necessarily looking for that big bump in equity growth. Perhaps they've already earned all of their nest egg and they just want to put their money to work so they can live their life. Or perhaps they have another way of growing their equity and they want cash flow. So for example, business owners might be fully committed to their business, but they want a stream of cash flow that's just kind of in the background so that they know that if anything were to ever happen, they have this consistent stream of cash flow. So usually I help people understand which one they are, which type of investment they are. It can be because of age. Oftentimes older investors are looking more for that preferred equity, and that's because they've spent a long time developing their wealth and now they just want an income stream. 10% is a lot more than you would get from a lot of different places that, from mutual funds or bonds, etc. 10% is pretty good return for a cash flow. If, on the other hand, you're trying to get your wealth to snowball, if you're younger in age and you're trying to really create that wealth snowball, then common equity is a good choice, probably, as long as you're comfortable with the deal and feel confident in it. So in that case, you're going to be giving up that consistent cash flow. Hopefully, you'll still be getting a bit of cash flow even in the down periods, but you're giving up that consistent 10% return. And in exchange, you're going to get a large equity bump at the end. So $58,000 in this case, on top of your cash flow that you received during the whole period. So that's kind of how things that's how things play out overall. I think that is, let's see. Yeah, that's kind of the end of the slides for today. I know it's a pretty short session, but I wanted to leave plenty of time for questions. So I'm going to pause the share right now and see if anybody has any questions. For those of you who have invested in our deals before, which deals do you like the best? Like, do you have any thoughts on do you prefer common equity versus preferred equity? Back to Zoom. Any other questions come up? Just want to make sure you guys are getting as much value out of this as you can. So please definitely let me know if you have anything come up. A lot of times people say, well, what really are the risks, right? Because if you're deciding between common equity and preferred equity, maybe you want to know, well, how much at risk is my common equity? And that's kind of what my job is. My job is to make sure that everyone, that we're doing the due diligence needed to feel comfortable in the deals, and to know that our operators are being good stewards of our money. And so my goal is to help people feel confident in the preferred and the common equity shares. And usually I'm investing in common equity because I'm in that stage in life where I want my wealth to snowball. But not everybody wants to take a risk like that, because it is a riskier position. If you just look at it from an objective standpoint. So Kalpana says, I like preferred because I get my money sooner in case it has a problem. Confidence will build over time. I think that's a good point. We're talking about large sums of money. And if you want to feel more comfortable, it can be comforting to get that stream of cash flow going. And over time, maybe you'll feel more comfortable and want to invest in common equity. Awesome. Any questions from anybody else? I'm going to go ahead and pause this. Going to go ahead and pause the recording.